Okay, so this is problem number 4 on exam 2 review. And it says, the following transactions are for Kale Company. And it has a number 1, a number 2, and a number 3. Instructions. Prepare the journal entries to record these transactions on the books of Kale Company. Kale uses a perpetual inventory system. So we're going to do A first. So on December 3rd, Kale Company sold $400,000 of merchandise to Thompson Company. Terms 1/10, N30. So that means 1% 10, net 30. The cost of the merchandise sold was $320,000. So remember, when you're the seller, you have 2 entries when you make a sale. The first one is to recognize the revenue. The second one is to recognize the cost of the goods sold and to get it out of your inventory, right? So let's go down here. All right. So I'm gonna move
Professor, can you repeat that again?
Yeah. Hold on 1 second. I'm trying to project something here. Yeah, when you're the seller, you are always doing 2 entries when you make a sale. Okay, 2 entries when you make a sale. 1 to recognize the amount you sold it for, and 1 to get the goods out of your inventory and recognize your cost of goods sold. Okay, so first thing we do is we recognize our revenue. So in this case, what did we get? Well, we got an asset in accounts receivable because we're going to receive the payment from the customer later. And we also got sales revenue. So accounts receivable is an asset. Assets have a debit balance. So we have to debit it to make it go up. So we're going to debit accounts receivable. And then we're going to credit sales revenue, $400,000. Okay, so that's for the amount we sold it for. We're then going to debit cost of goods sold for the amount that the inventory that we sold cost. And then we are going to credit inventory to get it out of our inventory. So we're debiting cost of goods sold, $320,000, and we're crediting inventory, $320,000. Okay, so that took it out of our inventory. Let's see. We then go to the next item, which is number 2, and it said on December 8th, Thompson Company was granted an allowance of $20,000 for merchandise purchased on December 3rd. So when you're the seller, if it's an allowance, you only have to deal with the customer credit part and the sales returns and allowances. If it is a return, you then have to put it back into inventory. And the way you'll know that is it's going to tell you how much the return cost, okay? But this one, it tells us is an allowance, and it only gives us the amount of money that we're crediting the customer. So we're going to debit sales, returns, and allowances, the contra revenue account. And we are going to credit accounts receivable. So we're debiting sales, returns, and allowances, $20,000, and we're crediting accounts receivable, $20,000 to give the customer credit for this allowance. So they kept the product we gave them, and we ended up just giving them a discount because there was something wrong with it. But they kept it. They didn't send it back to us. If it was a return, we would have to debit inventory and then credit cost of goods sold for whatever the amount of the cost was. And the problem would have to tell us that, okay? All right, the next one says, December 13th, Kale Company received the balance due from Tandy Company. So we have to look at the problem and say, okay, so we sold the goods on December 3rd. And we're getting paid on December 13th. So that is within the 10-day discount. Remember, the terms were 1% 10. So now we have to figure out all of the math part. So if we look on the screen here, we're going to see our sales were $400,000 minus any returns or allowances, which was $20,000. That gives us an accounts receivable number of $380,000. We're then going to take the $380,000 and we're going to multiply it by the discount amount. And the discount amount is 0.01 or 1%. And that's going to give us a discount dollar amount of $3,800. Okay. And then we are going to take the accounts receivable number minus the discount dollar amount of $3,800. And that's going to give us our cash amount of $37,200. Set that aside for just 1 second. I want to show you here on the screen. Do you see where I have that box that I just put my cursor on there? That is not part of this problem, but if there was a return, you know how that $20,000 allowance was just an allowance? If it was a return and it had a cost of $10,000, that's how the return part would look for that problem. I forgot I had put that on there. Okay. So that is not part of the problem. It's just a sample only if the cost was $10,000 and it was returned. Sample only of return. All right, so let's go back to this problem here where we figured out all this stuff, right? We figured out all the dollar amount and stuff, right? Okay. Let's see. So what are we getting? Well, we're the seller, so we're getting paid. So what are we getting paid? Cash. So we're going to debit cash $376,200, which is the accounts receivable number minus the discount. We're going to debit sales discounts, the contra revenue, for $3,800, which is the amount of the discount. And then we're going to credit accounts receivable $380,000, which is the amount of the accounts receivable that the account had, which was the sales minus any returns or allowances. Okay. So that's us receiving the payment with the discount taken. And then if you look at B on the problem, it says, assume that Kale Company received the balance due from Thompson Company on January 2nd of the following year instead of on December 13th. Prepare the journal entry to record the receipt of payment on January 2nd. So that means it would be past the discount period. So your cash and your accounts receivable number would be the same. Purchase or sales minus any returns or allowances, so $380,000. So this would be what the entry would look like on January 2nd if you did not take the discount. Okay, you would debit cash, $380,000, and you would credit accounts receivable, $380,000. Okay, I'm trying to see, I don't think I can fit this all on one screen. Yeah. Trying to fit it all on there real quick so we can get one good picture of it. There we go. Okay, and these are just accounts over here that I noted that you might use. Okay, all right, so I'm going to stop the recording there.